Welcome to discuss Forex trading. We'll be practically looking at Forex. Today we're dealing with Module 1, which is Introduction to Forex Trading and Global Currency Markets. So this module introduces the structure, the purpose, and the global importance of the foreign exchange market, which serves as the backbone of international trade and finance. For module objectives, by the end of these modules, learners should clearly understand what the forex market is and why it exists, how global currency systems evolve over time, the structure and organization of the forex market, the different types of currency pairs and how they behave, the roles of key market participants, how exchange rate systems function globally, the importance of trading centers and sessions. Lastly, learners should clearly understand how currency conversion and profit calculation work. By way of introduction, the foreign exchange market, Forex, is a global system through which currencies are exchanged. It exists because countries operate with different currencies, yet international trade requires a common medium of payment. For example, when a Nigeria company imports goods from Germany, it pays in euro, not naira. This makes currency conversion essential. Forex is the largest financial market in the world. It operates 24 hours daily and functions as a decentralized electronic network, making it unique among financial markets. Let's look at the definition and importance of Forex. So, the Forex market is a global financial marketplace where currencies are bought, sold, and exchanged. It enables businesses, governments, and individuals to conduct cross border transactions efficiently. The importance lies in the following: facilitating international trade, supporting global investment, enabling tourism and remittance, maintaining economic interaction between companies. Without Forex, global commerce would be extremely difficult and inefficient. Let's look at some of the key characteristics of the Forex market. The Forex market stands out to several defining features. They include: one, massive size. That is, there are trillions of dollars traded daily on the market. Two, decentralization. No single exchange or location. Three, high liquidity. It is easy to buy and sell currencies quickly in the Forex market. Continuous operation. It runs across global time zones. There is wide participation, which includes banks, government, corporations, and individuals. These are the features that make the forex market the most dynamic and accessible financial market. Let's look at a very important term in forex trading, which is exchange rates and company and currency pairs. An exchange rate represents the value of one currency relative to another. An example here, we have euro for the European countries, and we have USD, which is the United States dollars. So 1.1 for euro means $1 equals 1.1. 1.1 euro means 1 euro equals $1.1, for example. It means that for every $1, it is exactly 1.10 euro. Currencies are always traded in pairs because every transaction involves buying one currency and selling another. That's where the term currency pairs came from. Because it's always exchanged with another. It's always paired, like Nigeria and dollar, US and euro. It's always paired. Now, currencies are always traded in pairs because every transaction requires buying one currency and selling another. We have these two currencies. There are names we call them. We call the first one the base currency. We call the second one the quote currency. The base currency, like we have an example, is the euro, while the quote currency is the USD. Exchange rates change constantly, creating opportunities for profit and for risk. Let's look at supply and demand in Forex. Exchange rates, already explained, are primarily determined by supply and demand. When demand for a currency increases, its value also increases. When supply exceeds demand, its value falls. The key factors influencing the key influencing factors of supply and demand in forex include interest rates set by banks like CBNs of countries, inflation in the country, the economic growth present in that country, political instability, trade balance. These factors cause continuous fluctuations in currency prices throughout the day. Let's look quickly at the structure of the forex market. The forex market is structured into interconnected layers that work together to facilitate global trading. They're divided into four basically. We have the first, which is the interbank market. We have the second, which is institutional market. We have the corporate market, and we have the retail market. Each layer contributes differently, but together they ensure liquidity, efficiency, and price discovery in the global currency system. We're looking at the first and the second together, the interbank and institutional market. Now, what is the interbank session for on Forex? The interbank market is the highest level where large banks trade massive volumes of currency and determine exchange rates. The institutional markets includes hedge funds, pension funds, and asset managers who trade currencies for investment and risk management. Participants under this kind of market are, like I said before, control large capitals. They influence market trends and they also provide liquidity. Let's look at the other two, which is the corporate and retail markets. The corporate market consists of multinational companies that exchange currencies to conduct international business, such as paying suppliers or receiving foreign income. The retail market includes individuals, traders who access forex through platforms like the MT4 and TradingView, often engaging in speculative trading, that is predictive trading. Technological advancement has made forex accessible to everyday individuals worldwide through the retail market. Let's look quickly at the history and evolution of forex. How did it come about? Now, forex started with the barter system where there was direct exchange for goods. From there, it moved to commodity markets where gold and silver were exchanged for goods. Then gradually, it moved on to the banking system where some persons held on to goods or properties for other people. Then gradually, it moved on to the gold standard where there were fixed currency values, like using cowrie. Then we had the Bretton Woods system introduced by the US in 1967, where they adopted dollar as the primary trading currency for the world. Then it gradually moved on to the floating systems, which comprises of market-driven exchange rates. Then we have finally the modern era, which is concerned with electronic global trading. This evolution reflects the growth of the global trade and financial systems. Let's look at, we already discussed currency pairs, relationship between two currencies, but they are classified majorly into three. We have major pairs, we have minor pairs, and we have exotic pairs. For the major pairs, they have high liquidity, e.g., USD. For the minor pairs, they have moderate trading volumes. While for the exotic pairs, it has higher risk, and this is usually found in developing economies. This is the currency of developing economies. Each type differs in liquidity, volatility, and the trading cost. Let's look at some of the market participants. The forex market includes diverse participants. We have one, central banks of countries. What do they do? They control monetary policy and stabilize the currency. Two, commercial banks. They facilitate transactions and provide liquidity. Three, hedge funds. They speculate for profit. Four, corporations. They support international trade. Five, retail traders. These are individuals investors. They are referred to as retail traders under the forex market. Each group play a crucial role in maintaining market activity and stability. Let's look at currency systems and the balance of payments. There are two main exchange rate systems. We have the fixed system and we have the floating system. The fixed system, this is where currency value is controlled. While for the floating, this is when the value is determined by the market forces. Now, what about balance of payments? International transactions are usually tracked using this. And there are three kind of accounts under the balance of payment. We have current account. This is the trade account. This is where trade account transactions are recorded. Capital account is where transfer of assets are recorded, while financial accounts are where investments are recorded. This helps a country assess a country's economic position globally. Then we have trading centers, sessions, and practical applications. Forex operate through major global centers. We have London, New York, Tokyo, Sydney. Each create trading sessions with the London, New York overlap being the most active. In real world application, exchange rates changes affect business cost. For example, a Nigerian importer may pay more if the naira weakens. That is, exchange rate has increased. For example, small price movements, PIPs, can generate real gains in trading. By way of conclusion, this module has explored the fundamental structure of the global foreign exchange market and its role in facilitating international economic activities. By examining exchange rate balances or system, balance of payments, currency flows, and major trading centers, we have gained a deeper understanding of how currency are valued and traded globally. So at the end of this module, there's um, 15 quizzes to be answered and a short report to be written to better understand what has been taught in this module. I will see you in module 2.